This is going to be a very decisive week. You've got elections. They begin tomorrow, plus the beginning of a two-day Federal Reserve meeting, which means we could learn more about its plans to stimulate the economy. Maybe they'll give us some specifics. And then on Friday, you've got the October employment report giving us a snapshot of the state of that economy right now. So how can you get ready for anything in the next 5 days or just throw away all plans? Well, we've assembled a special Taking Stock think tank to tell us about it. We've got Sean Egan. He's the president and founder of Egan Jones Ratings. He is here. He was named one of the 6 people who predicted the credit crisis by Fortune magazine. We also have Paul Lountzis, founder of Lountzis Asset Management, a Warren Buffett-style value investor. Berkshire Hathaway is his biggest holding in the portfolios right now. And Adam Seessel of Gravity Partners. He founded Gravity back in 2003 after leaving Davis Selected Advisors, where he was the number 3 person on their research team. He's also a winner of the George Polk Award in journalism. Good to have you, gentlemen. Great to have you with us.
Thank you.
Sean, let me begin by sort of posing to you some of the things that you've written, which is that there are 3 legs to the stool that really people need to be paying attention to. What's the consumer like? What's business like, and what's government like? That kind of encapsulates everything, doesn't it? Give us the context.
Absolutely. The consumer, it's been well documented that the consumer is having difficulty, that the house values, which is the biggest asset, has declined, and they're slowly recovering from that. Business, in contrast, for the most part, is in terrific shape. You know, you see operating margins improving dramatically. You see a lot of cash on many companies' balance sheets, so we don't worry about that. It's the last one, the governments, that we do worry about, not only in this country, but a lot of other countries. For the simple reason that the government has taken over a lot of the bad debts of the financial system and then put on their balance sheet. And so you see sovereignty after sovereignty slipping over the past several years to the point where you wonder exactly how it's going to end.
Paul Lountzis, come in on this topic, because we've got these 3 legs of the stool, as Sean describes them: the consumer, business, and government. You're a value investor. Would you invest in the government if you were able to really be an equity holder in the U.S. government right now? Would that be a value play?
We would not. And with the upcoming elections, which, important point for us, Pimm, we don't spend a lot of time on macroeconomic factors. We simply can't predict interest rates or inflation or GDP growth. But in terms of the consumer, everything Sean said, we agree with 100%. The government has enormous issues ahead of it that they're not really focused on, nor are they fixing them. The only sector that seems to have some strength in terms of its balance sheet is the corporate sector. Corporations have $3 trillion in cash.
So that's a good thing for the corporate sector.
It's a good thing, but they're not spending it.
At least not yet. Adam Seessel, is there a time when we're going to see corporations start to loosen those purse strings a little bit?
Well, we'll see. But, you know, in terms of valuation, I agree with your other 2 panelists. I mean, corporate profit margins, as Sean said, are at near record highs. So the multiple of the market is artificially low, if you will, because corporate profit margins can't get any better from here, maybe a little bit better. But they certainly can get worse if we have a nascent labor movement and so forth. So the valuations of the market to us look quite rich. So we're very happy to sort of stand pat where we are. As value guys, the first rule is don't lose money.
Sean Egan, is it possible, though, that the elections tomorrow will be anticlimactic for investors, since everyone seems to be pointing to a Republican victory in the House of Representatives?
We don't think that's going to have a major effect. You know, the emergence of the Tea Party as a major force really has put a bump in the road in our path towards socialism. It's slowed it a little bit down a little bit. Hopefully, some fiscal responsibility is going to return. It's likely to, but it's really, in the whole scheme of things, it's relatively minor.
So is this going to be a situation where we see just more of the same, more dollar weakness, more kind of bumping along on the bottom in terms of unemployment?
Hopefully not, because there's some structural problems that have to be solved. It doesn't make sense for the bonds and the dividends of a company to be equivalent. And basically, there's something that doesn't fit in the economy, and we can get into that, but it needs to be addressed, and hopefully will over the next 6 months, or we're going to just continue bumping along probably over the next 5, 7, perhaps 10 years.
Sean Egan, this idea that there is a dislocation somewhere in the world, because how is it possible that you would loan your money to a company, not take any equity position, but loan your money in the form of buying a bond, get paid less than if you actually decided to take on the risk of owning the stock of a company and the company returning you a greater dividend yield. Is there something bizarre about this? I'm thinking, for example, you've written about AT&T.
Yes, there is something that's preventing the arbitraging away of that situation. And basically, it's that our financial system isn't working properly. And it also has to do with the problems in the market. You know, what's the biggest cure to fear in the market? Well, it's greed. You know, you just see a couple companies being taken out at a 30 or 40% multiple, or 30%, 40% premium, and it takes care of it. The problem in the fixed income market is that the securitization process beyond the Fannie Mae and Freddie Mac is completely broken. So that leverage buyouts aren't taking place the way they should. It should be the case that some companies are taken out and you can roll over the debt, but you can't right now. The banks are scared, and so there should be some other sources. The problem with the other sources is they can't take the funds from the buyout and roll it into the market, securitize it, and do it a number of times.
Because interest rates are low. You'd think there'd be lots of money available for this kind of stuff.
Actually, it's more than that. It's that the trust is broken in the securitization market, and all the problems with the documentation, with the putback of the loans, is a manifestation of the fact that there weren't any checks and balances. That if people could believe that these securities are, let's say, AA rated, then you could quickly sell those securities. Now they don't know if they're actually single C rated, and so you don't have the capital sources that you need. Once that is fixed, you can have some turnover of the capital, and you can arbitrage a situation where AT&T's bonds are yielding the same as the dividends. And hopefully that's going to happen, but you need to restore some of the trust so that the non-experienced buyers, the marginal buyers, can get in and buy some of these repackaged securities that are at the high investment grade level. And you know, you really need that, or you're going to have the banks not lending, you're going to have the mezzanine debt sources not doing enough business, and you continue to have problems in the market.
Adam Seessel, is this an incremental situation where we get greater trust, but it comes in very small steps? Or is there a point where the light bulb goes on and everyone says, okay, we can trust everyone again, let's write some checks, let's lend some money?
Well, I don't know. I mean, you know, we have been burned for the first time in a credit crisis for the first time in a generation. And so Sean's right, it takes a while to repair confidence. But, you know, as basically a bottoms-up value investor, we tend to agree with Sean's take that there are a lot of cheap companies out there, individually discrete companies, but the macro situation is very grim. So it's a tough way to balance it. So we, who just started a mutual fund October 1st, long biased, not long only, so we can take our chips off the table. You know, we're about 50% net exposed, so we're half in, half out, and really finding only value in two categories: special situations and really the mega cap stocks, which have, you know, their multiple has come down from 40 to 14 in the last 10 years.
And Walmart is one of the stocks you've been looking at, right?
Walmart we love. It's 13 or 14 times earnings, down from 40 times earnings in a decade. You know, the stock is flat in 10 years. But the earnings have gone up 2 or 3-fold, so the multiple is compressed. And if they were paying a real yield, they would be yielding 7 or 8% now. So we kind of like those stocks. They're hiding in plain sight.
Paul Lountzis, this idea of trust, Berkshire Hathaway, your largest position, trust is crucial to the investment process, whether it's bottoms up or top down. Is this trust going to be rebuilt in the next 2 years, or is this a generational issue?
I think it's going to take a long period of time, and just a side point I would add, we trust Mr. Buffett a lot more than we trust the government, which is why we own so much Berkshire, and I think that's a no-brainer. But what I would say is that trust is permeating throughout the economy, both consumers, institutions. I think a lot of Main Street has lost a lot of faith in Wall Street. There's many people who were burned so severely in the stock market they're never going to return, or they're not going to return for a long time. And I think that is underlying a lot of the issues that's creating the challenges and the problems today.
You know, I was just going to say, Paul, I mean, a lot of trust is, you know, for us who are in the individual business of rating, whether it's equities in our case or Sean's case, bonds, a lot of trust is granular. So as Paul said, of course you trust Warren Buffett. Of course we trust the management of Walmart. We trust the management of Exxon. Now, the management.
But do you trust the way the U.S. government's being run right now?
Well, I mean, government's always got a bunch of problems. I mean, you go back and read your financial history, you know, it was the S&L crisis, it was the lesser developed nations crisis. In the 50s, it was the ag crisis. So
it's a lot of crisis to go around.
Government is always a mess.
Sean Egan, so what needs to happen to the government in order to right some of these issues? Is there anything that the Federal Reserve can be doing? You write about the end of the Pax Americana. I want to get your thoughts there, but is there anything that Ben Bernanke should be doing other than maybe wearing like a Superman uniform, or what can he do?
Well, I think it's worthwhile stepping back and finding out why it is that we're in this mess. It's because there's been a change in the funding of major assets, from the banks holding them to the securitization. And that securitization process has broken down. And there's a lot of different indications of that. You have to find out why it's broken down, why the trust has broken down, align some of the interests, and then you fix that problem so that marginal investors, major marginal investors, can be comfortable in investing in securities where they don't have to put in a lot of time and effort in researching it. And then the capital will start flowing. Then a few more buyouts will happen. Then the market, instead of having fear, you'll have some greed starting to replace it. And the problem of the U.S. slipping is not such a major problem. London does beautifully, much better now than it did 50 years ago when it was on top of the world. So it's something that needs a little bit more than just a brute force of buying securities and hoping to reduce interest rates. And the argument can be made it's already as low as it should be anyway.
Well, you've written that perhaps half of the U.S. financial system has just gone away.
Absolutely. Half has gone away, and the other half is in difficulty. So you want to find out where it went and hopefully get it back again.
Well, Paul Lountzis, if half the U.S. financial system, that shadow banking system that Sean writes about, has just disappeared, does that make certain areas of the market of greater value? Because, as Adam was alluding to, it's in times when you can't trust anything that those that can pinpoint those areas that are trustworthy, that's when you really show your mettle.
I think, Pimm, that there's certain industries now, banking to name one, the financial services area, those are areas that have really been harmed, and some of it's good. Some of the things that took place shouldn't have taken place, and they've cleaned it up. Unfortunately, the government oftentimes goes to the other extreme. So, for example, in the healthcare industry, the government's stepping in and telling HMOs what their MLRs should be, or their medical loss ratios, 80%.
Medical loss ratios, explain what that is.
The MLR is the amount of money that the HMO must spend on healthcare services. And for small company and individuals, it has to be 80% now. So 80 cents of every dollar have to be spent for that. For large companies, it's 85. And I don't understand why the government should be in the business of deciding on the profitability of individual corporations. For-profit schools, there's been a lot of fraud and unethical behavior, and that should clearly be cleaned up. But some of these rules that they've instituted are very punitive and impacting, a lot of the population that really needs access to these schools. So my concern is the government, when they're trying to resolve an issue that has been left go, they go to the other extreme, and that creates even more problems than it solves.
Adam Seessel?
Well, just to jump in on Sean and Paul's macro point, I mean, talk about the financial system, the banks, to be specific. All those guys who did securitizations, the investment banks and the Bank of Americas of the world, they have been materially harmed by their lax lending practices. But the guys who were much more inclined to hold the loans on their books, the Wells Fargos, the M&Ts, who had much less securitization, much less derivative, much less funny business going on, they have actually come out of this crisis a lot stronger. Wells Fargo bought Wachovia and doubled their low-cost asset base. M&T just bought Wilmington Trust at a favorable price.
The problem with the securitization per se. It's the way it's being done.
Right.
And also it's the institutions that have been harmed, and their shareholders, and the individuals oftentimes have done beautifully.
I suppose I'm just making the point that a whole loan held on the books is going to be by definition safer and underwritten better. A big problem in the securitization market was no one knew what the heck they were buying.
Well, it didn't matter because they didn't really end up holding it once they bought it. They just sold it to somebody else.
That's right.
The problem with not having securitization is that you have a one-to-one situation.
Right.
Basically, basically you make a loan and you hold it for 25 years or so. The advantage to securitization is you can bring in the marginal players. You can do the transaction and then you can parcel it out. And those parties are better off holding securities for 20 some odd years.
Just getting back to an individual stock picker's perspective, the granular folks you can trust the folks who make the loans and keep them on their books, because they're not playing a game where they're selling it out and securitizing it for a fee. M&T, they say the only loans we made that were bad were ones that we bought wholesale. The ones that we knew that we made in our backyard, those were good.
And it's also a question of management integrity in terms of doing right by the client. And it's very, very difficult when you're seeing everyone else bringing in enormous amounts of revenue and you're compensating your people accordingly, and you pull back the reins and you tighten standards because you don't want to do pick and pay loans. So
it's at those points that the shareholders come screaming to you because they wonder, okay, short term, how come you're not doing as good as the guy next door?
Exactly.
They don't look 2 years down the road and say you're still standing.
But that's why management is in the position they're in. They have to stand firm and fundamentally not capitulate.
Sean Egan?
I think it goes, in my opinion, it goes beyond management because there's a natural need for management to sort of push. What you've done sort of structurally is you replace the loan officer, the credit officer, the head of the credit committee, and the regulator with nobody. You have nobody looking at it right now. No one's accountable. You need some adult supervision, somebody whose head is going to roll if you're wrong about assessing the credit quality of these underlying assets, making sure the documents are there, making sure that people live in the houses, make sure they have the income.
And that's why we have you, Sean Egan, and I want to thank you. We've got to leave it there. Sean Egan, Paul Lountzis, Adam Seessel.